Investment styles are consistent and methodical methods of investing. Investing methods can help you be more methodical and disciplined in your investing by using a set of criteria or a theme to help them make investment selections. They also allow you to track and compare the performance of your investments, which is extremely useful because setting investment goals, let alone knowing if you're meeting them, is extremely difficult. There is no strategy. Before we go over the most popular investment methods, to begin, it is critical to review some general investing fundamentals. Even if you're afraid of losing money, you should never rush into an investment, because it almost always backfires. Smart investments are rarely those that everyone rushes into or debates. Instead, stick with what you're familiar with. If you don't understand an investment strategy, you should either avoid it or learn more about it. Investing in stocks is similar to avoiding companies whose business model you don't understand. Buy and hold. The most fundamental long-term investment strategy is investment, or buying and holding. Individual stocks are simply bought and held for an indefinite amount of time. Despite being the most basic of investment strategies, the performance of a buy and hold portfolio is obviously determined by the company's health. Investors are frequently their own worst enemies, selling investments at inopportune times. Buy and hold can be more effective than one might think. This method, however, solves the problem. To begin, a buy and hold portfolio can be significantly improved in two ways. Look for stocks with a long lifespan. Buying stocks with a strong brand that are unlikely to be disrupted is a good option. Second, keep the number of positions as low as possible. That way, any bad picks won't have a significant impact on your portfolio. And the stocks in your portfolio that perform well will grow into significant positions for growth investment. The greatest advantage of growth investment strategies is that they expose you to the fastest growing sectors and industries. This means you're investing in companies that have the best chance of generating high annual returns. Growth stock investing is also exciting because you get to learn about companies that are innovating and shaping the future. However, growth stock investing should be approached with caution. Growth stocks typically have the highest market valuations. To justify their valuations, they must live up to market expectations, or the stock price will often correct dramatically. If you want to invest in growth stocks, you should do your homework and avoid chasing companies solely on sentiment. 3 investments with high momentum. Momentum investing is similar to growth investing, but instead of focusing on earnings or revenue growth, it focuses on stock prices, which have statistical momentum. The best performing stocks in a given period are likely to outperform in subsequent periods. Price action is thus used solely to make buying and selling decisions, though it does aid in avoiding small and illiquid companies. A simple momentum strategy would hold 10 to 20 of the best performing stocks for a year. At this point, all stocks are sold, and the process is repeated on a monthly basis. More sophisticated variations of this strategy will continuously rotate capital into the stock with the highest momentum. Momentum investing produces positive results most of the time, but it can also produce significant losses. Other methods should be used in conjunction with momentum or value investing strategies. Value investing has produced the most consistent long-term returns over the last century. Warren Buffett amassed his fortune by investing in companies that generated consistent profits at reasonable prices. Value investors buy stocks that are trading at or below their intrinsic or fair value. This provides a safety net in case something unexpected occurs. The lower the stock's purchase price, the less the company must earn in the future. To generate a reasonable return, investors must understand financial statements in order to determine a company's true value. The majority of low-cost equities are just that, low cost. A value investor's goal is to find high-quality, low-cost stocks for a reason. 5. Invest in small-cap stocks, focusing on smaller businesses. There are 2 advantages. To begin with, it is easier for a small business to increase its earnings. It is much easier to double income from a base level of $100 million to $10 billion. Second, smaller companies are more likely to be overlooked by investors, causing their stock price to fall. Other investors will take notice as the company grows, and the discount will narrow if you are an early investor, rewarding you with a higher return. However, investing in small-cap stocks has a few disadvantages. It will be more difficult to obtain information, and you will have to devote more time to research. Small businesses are also less liquid, with more volatile stock prices. Therefore, you must carefully manage risk and avoid situations in which liquidity runs out before you can quit. Investing in 6 dividends. Dividend investing, also known as income investing or yield investing, seeks to provide a consistent source of income. While stocks with high dividend yields are typically profitable, their growth rates are slow. As a dividend investor, it is your responsibility to choose companies with a high yield that will be able to continue paying dividends in the future. It would be even better if the company could increase its dividend yield. Dividend investment methods are about more than just making money. If dividends are reinvested, a yield portfolio can see significant capital growth. Dividend-paying companies are often profitable, making them defensive during downturns. There are 7 environmental, social, and governance issues. Investing by ESG. According to the Logic S, investment evaluates how environmental, social, and governance factors affect the company's long-term value. Companies that take environmental governance seriously are more likely to prosper. ESG investing includes socially responsible investing, impact investing, and ethical investment methods. These policies, on the other hand, seek to limit the way capital is deployed. ESG investment investigates the effect of similar issues on returns. Individuals can purchase ESG funds or ESG grading services can be used to select stocks prior to investing in a fund or subscribing to a rating service. The discipline is still in its early stages, and the efficacy of these tactics must be established. It is advisable to conduct some research. 8-factor investment. Factor investing is a method of stock selection based on evidence. Investment factors are stock features that have been shown to outperform over long periods of time. Value, growth, market value, and momentum are just a few of the most commonly used characteristics. 2 other prominent factors mentioned are volatility and quality. In factor investing, these ideas are reduced to quantifiable criteria. ETFs has been introduced by a number of quantitative investment firms. Using these items, exchange-traded funds that index stocks. Using factors, advisors, and even individual investors can build portfolios based on empirical facts rather than theory. Indexing, also referred to as passive investing, is a type of buy and hold investing. Indices are preferred over individual stocks. This strategy has several advantages. For starters, investing in market cap weighted indexes means you'll be putting your money into the fastest growing large cap companies in the stock market. This eliminates the need to select stocks and ensures that you own all of the important ones. The most common way to go with passive investing is through ETFs, which has relatively low costs compared to other products. A single transaction commission allows you to hold dozens, if not hundreds, of stocks. According to research, most actively managed mutual funds do not outperform their benchmark. By investing in passive ETFs, you can track the benchmark while also saving money. The same as compound interest. The money saved on fees accumulates over time. This factor alone can result in significantly higher long-term returns. Passive investment strategies, such as the buy and hold strategy, prevent investors from ruining their returns by selling at the wrong time. 10 Core Satellite Approach. The core satellite investing strategy combines passive and active investing strategies. The fundamental portfolio of ETFs is held, as are a few actively managed stocks. When valuations are excessive, this allows a fund manager or investor to profit from rare opportunities that index funds would overlook. Individual stocks, for example, can be purchased or sold, and exceptional smaller companies can be invested in passive funds, which account for roughly 70% of the total. Active strategies account for the remaining 30% of satellite portfolio allocations. Any of the previously mentioned methodologies can be used to allocate the funds. Part 11. Active long-short sale. One of the few ways to profit from the market's downturn is to invest in short selling. Combining long and short bets in a portfolio lowers market risk and isn't just for profiting from a stock market crash. The relative performance of 2 instruments can provide profits regardless of which direction they are traveling. As a result, market-neutral hedge funds use long and short strategies to generate returns with little market correlation and can be used to reduce the volatility of larger portfolio investments. The Data Intelligence Fund, managed by Leonard, employs market-based long and short investment strategies. Hundreds of sources are used to compile user-generated data, which is then used by artificial intelligence to gauge market mood and identify potentially profitable patterns. Long-term stock investments with 12 assets typically produce the best results. Despite being the riskiest asset class, combining multiple asset types can produce superior risk-adjusted returns. The lower the volatility and portfolio risk, the better. Stocks, bonds, cash, commodities, real estate hedge funds, and private equity funds are all possible components of a well-diversified portfolio, and diversification can be further enhanced by distributing the stock portfolio among the previously mentioned investment strategies. What factors should you take into account when deciding on a personal investment strategy? There are several factors to consider when deciding on the best investing strategy for you. To begin with, the strategy should pique your interest. If a method appeals to you, you are more likely to learn about it and conduct the necessary research. The second, in some cases, your own skills and knowledge may give you an advantage. Financial statements, for example, are critical in determining the worth of an investment. It can also help if you have prior experience in a specific industry. You might be drawn to momentum investing if you know how to code and want to create your own algorithm. Another consideration is how much time you have to devote to conducting the necessary research. For value growth and small cap investing, it takes a long time, whereas momentum and passive investing take a short amount of time. Finally, you should consider your risk tolerance. This is related to both your finances and your personality. If a volatile investment is keeping you awake at night, passive investing or a portfolio with a broad asset allocation will be more appropriate. You have a size and flexibility advantage. As an investor, you can take advantage of this advantage by combining one or more of these investing approaches to develop your own distinct strategy. So, thank you very much for tuning in. Have a wonderful day, and I'll see you in the next.